So it's interesting, being in the SFR space for now the last 13 years, this is the first time we've seen a little bit of slowing in the rent growth into some declines on our rental rates, largely driven by a lot of new supply coming into the market on the backside of a lot of build-to-rent developments and other movements that we've had conversion into rentals through existing people not wanting to sell their home and basically lock in their low interest rates. So that's created some downward pressure on rental rates. I think we're past what I would call peak deliveries of build to rent. We're seeing data that shows that those will decline over the next 12 months. So if you want to call a little bit of a bottoming out effect, where we'll get back to more normalization of our supply and demand.
I think it confirmed things that I already had a sentiment for. No big surprises, but I think it confirmed that there's a little bit of market softness. I think on the rental side, we're seeing more competition, but on the retail side for the home builders, there's definitely some softness. I heard that their volumes are slowing down, their margins are getting tighter, which are things that I had heard. And I think that creates opportunity to actually do business. Because when the market's super hot, as it was a few years ago, land is very expensive, it gets bid up. Home builders don't give us as much attention because they get a lot of attention from retail buyers.
I think product size, product design is interesting, continues to evolve the space. And then I think forward-looking projections for next year and the year after. We see supply starting to really change and what we expect to be delivered changes. And there's been a lot of positive conversation about that.
I think that speaks well to the SFR industry. It's very resilient because we haven't really seen massive degradation in rates, but just some, largely through more choice to the consumer, and that's probably a good thing. Balance is what we like. I don't necessarily want to have too much supply or too much demand. I think that creates some imbalance, and I like to see a nice healthy real estate market, and we're monitoring that closely as we move forward into 2026.
And some of the euphoria of 2020 and 2021 of BTR growth and development was beginning to wane. And it was exciting, but you could just kind of feel people were wondering when the shoe was going to drop. And then all of a sudden now, here 3.5 years later, I can begin to see some shoots of excitement coming off the huge supply of trying to maybe want to go again. So we really sense some real excitement in the group. I mean, look around, it's pretty busy.
So now that things are softening, I see more opportunity to actually get deals done together. Maybe the price of land is going to come in. Maybe we're finally going to be able to do finished lot deals together. Maybe the bid-ask spread for deals between BTR groups and home builders is tightening. And I think that gives us a lot of hope that over the next 6 to 12 months, we'll do more business. So the softening, in a way, I think can be good catalyst for getting deals done. More about market optimism is about this slower environment is more conducive to actually getting deals done. It's not an overheated market. So yeah, cautiously optimistic about doing more business, and the fundamentals I think are going to probably start going in our favor towards next year.
I think what makes it unique is that it's so new, relatively. I mean, I just left a conference, we're talking about if you're a veteran, you've only been in it 10 years because it's relatively new asset class. So what I like about it is we're kind of inventing it as we go and understanding it. There's lots of lessons learned and people are pivoting and responding to those lessons. So I think it's not often you get to be part of kind of almost a startup asset class. So I think that has a lot of value and people appreciate it.